All right. Welcome, everybody, to this new RedStone Live. I am your host, Mike Massari. I'm strategic advisor at RedStone. And today we're going to talk about to peg or not to peg. That is the question. We are unpacking uh, some of the most controversial ideas in DeFi. Specifically, we're going to talk about synthetic dollars. We're going to talk about what happened in October 2025, the Oracle case, and we have with us a couple of very, very experienced people. We have Sam, which is the CEO of Spark, and we have Uday, which is a senior researcher at Gauntlet. Sam, would you like to introduce yourself?
Yeah, thanks for having me on, and thanks for hosting this event. So I'm Sam, co-founder CEO of Phoenix Labs, which is the main contributor to Spark. Yeah, we are commercial lending within the Sky ecosystem. This is surrounding the USDS stablecoin, which is just as of a few days ago retaken third position as the third largest stablecoin in the space. So we're doing lending across DeFi, CeFi, and TradFi, mostly focused on crypto lending in EVM land.
Awesome. What about you, Uday?
Yeah, hi. Nice to be here, and thanks for calling me in. I'm a senior researcher at Gauntlet. I mainly work on the perp side of things, pretty much like most of the market making side of like the vault making operations. Try to work on that. Have been working on such algorithms for the past. Previous life has been pretty much a banker, have where we do some quantitative machine learning models for like credit in general. Um, yeah, again, I think a brief disclaimer: the views I have will be my own, like not related to my company in any sense, and um, yeah, I mean, not financial advice in any sort.
Yeah, we're gonna have a good disclaimer. We're gonna have a very frank conversation. We're just gonna give our opinion on things. Don't take any of this as financial advice. Always do your own research and make your own decision. That said, I think that we can probably dive headfirst into what is the macro context of all of this, like the famous like Oracle case. So, what is, Uday, the Oracle case for the market crash that happened on October 10? What are the key indicators or the events that it is based on?
For 10th, I mean, majority of the people just look at it as like some sort of Trump tariff or some geopolitical issues that came in. But what was interesting was much before the announcements were made, there were a couple of like anomalies that were observed. Specifically, one of the anomaly is Binance has this auto conversion on its perp exchange, like any sort of collateral that you have. Uh, Generally you get a haircut and you get that into a dollar value. If I have like $1,000 worth of Bitcoin, then I get probably like 3% haircut, and say, okay, this user has like 970 dollars worth of Bitcoin. So that user can basically trade using this collateral and do some longs and shorts, basically do perps. Now, what happened was how you determine the dollar value of your collateral is basically they are mainly looking at it based on their order book. So there's a decent amount of like buy and sell that's happening on USDE and like a couple of other assets. Um, so the attackers mainly try to nuke the order book of USDE on Binance. So what happened then was the price of USDE, which was supposed to be $1, depegged. They because the order book liquidity is not that strong. I mean, relatively compared to other markets, Binance had a vulnerable order book market for USD in general. So since that market has the price has gone down, whoever that was holding this as collateral and were making long and short options, their collateral kind of like fell down from like $1,000, it fell down to maybe like 20% and 30%. That triggered a lot of liquidations, and then the geopolitical news added as like a compound effect. So yeah, I mean, to your point, the Oracle case is mainly like Binance should have used the oracles instead of just going by the order book itself. If that was the case, then the vulnerability could have been avoided. Binance had made a decent amount of payout for all the people who were impacted due to that event. But yeah, that's the background. There's been a decent amount of chat on the perp side in terms of like how this can be mitigated and how this needs to not happen again. There are a couple of like solutions being presented, but yeah, that's the background.
Yeah, and it's interesting. I want to talk about a bit more about the solution, like later on in the chat. Sam, what's your take on this?
Yeah, I think there's a couple of things here. One, like I agree with Udai's assessment that the usage of the pricing for USD and other assets is clearly Binance's fault in this case. They should have been using a diversified set of like sources for like pricing information and not just their own order book. So in that specific case, yes, I think that was clearly Binance's fault, and even they admitted to this by repaying a lot of the bad debt that was incurred there. I think there's kind of a more general debate about whether they should be using market price at all for what is a reasonably illiquid asset, which is USDE. So there are, liquidity is like a gradient. You can have lots of liquidity on one end, and you can have like be optimizing for less liquidity on the other. So for like a lot of the leverage on USD in particular in DeFi and other venues, a lot of the times there is not a market price used for specifically the reason that I could speak about Spark. Like we've done lending against USD in the past, and we've never used a market price because we feel that exposing borrowers to this, like especially at the scale of Spark, which does like hundreds of millions, even billions sometimes in loans, there's not enough liquidity in the market to be able to liquidate these positions at that size. So it turns out if the lender is comfortable with underwriting the issuer, then it's actually better to just accept that risk and then not be doing some sort of fire sale liquidation if there's some liquidity issue. Because it is important to differentiate the two types of issues. Liquidity issues, which are far more frequent, especially with liquid assets. This is like a temporary depeg, which then it returns. These issues are kind of okay to deal with. You can, especially as a lender with like a large amount of capital, you're okay with liquidity going away for X number of even days. Sometimes it depends on your risk model. The issue that is like where this moves the risk to, though, is that if there is like an insolvency somewhere, then the lender increases their exposure to a permanent insolvency. This would be more about like a permanent depeg, like in the case of like Terra Luna, for example, where the product was fundamentally insolvent. So it's really all about trade-offs. And in my view, I don't even think Binance should have been using a market price. They should have just looked at it as more of the underlying assets, what the value is there, if they're going to be engaged in this type of large-scale lending. And I think this is pretty unanimous across all the large lenders in DeFi. So Spark was always using pricing it at NAV for USD in particular. Aave originally started with a market price, but quickly realized that this was not the way they go once they started scaling up, and they switched to Spark's mechanism of pricing it at the underlying NAV. I think it was several months ago. So yeah, I think for this asset, and it varies based on the asset and the loan size and all that kind of stuff, but yeah, for this particular asset, I think usually pricing it at NAV is kind of the better way to go.
Yeah, fair enough. And it's interesting because Sudha, you mentioned obviously that this was somewhat the result of a geopolitical situation, right? And it's fascinating always to me how the crypto market, as much as we think and we like to think that it's very different from the traditional market, it somewhat follows the same trend and somewhat follows the geopolitical state. What do you think are like the forces that can drive a downturn like this? So obviously the downturn was quite synchronized, right? So what do you think are maybe the geopolitical forces or other forces that can drive like such a synchronized downturn across multiple assets across the whole market?
So you said synchronized downturn, right? I mean, it's important that we kind of like click on that. If you look at how the mark price fluctuated across different perpetuals, there was a market difference. I mean, for like, why do we use mark price? Mainly, perps use it for like liquidations. Like when the mark price becomes like closer to liquidation, you generally are like ready for liquidation, or we are eligible for liquidation, etc. But the key thing is like I have done some research where the mark price of Solana on Hyperliquid is almost like 15% lower than the mark price of the other exchanges. Why is that? Because each exchange has their own way to calculate mark price, and it doesn't really reflect it today. Like today, the markets are normal. I mean, not normal, but not stressed as 10-10. So right now the deviation will be very little, but on a certain point in time you will see a big deviation that happens across all the perp exchanges. Now why is that? Is mainly because of the way they calculate mark price. So one exchange says Solana price is 150, somebody else says it is 135. Who do I believe? um, when you have such different range of mark prices, liquidations tend to be much more aggressive. Generally, most of the people go long, so most of the liquidations that uh, happen when markets go down in general. So yeah, I mean that's like one piece of evidence that I found really interesting. We should probably stick to like some form. You could have like different notations, different philosophies, but at the end of the day, if you are wildly quoting multiple numbers across multiple exchanges, that is probably like one trigger. Is like, who do I believe? Yeah.
Yeah. So Sam, do you think that there is, this like the liquidity cycles on like debt or overall, like maybe even like the AI bubble that effectively influence the downturn, or what are the factors in your opinion? Was it like a geopolitical thing? Was it just because of the pricing, as Uday is saying?
Yeah, I mean, so there's like this underlying increase in leverage in the crypto markets that was kind of being put on like over the months. But obviously, the straw that broke the camel's back was the Trump announcement. I think that is very clear causality there. But yeah, I mean, like both things can be true. I think the market, I think, was kind of moving towards breaking, and just an event can kind of set it off.
Yeah, and I'm gonna stay with you for the next question because it's actually a very interesting point, right? You mentioned leverage, and we saw even in traditional markets, right? For example, what happened in 2008, right, with the traditional like real estate market, and then we saw what happened in 2020, obviously with COVID. So how do you think that like the leverage and like the exposure of derivatives, for example, today compares to that, and like in terms of obviously systemic fragility, in terms of like market heading towards a downturn?
Mainly, I think even though leverage has increased overall compared to what we saw back in the day, there are decent amount of checks and balances that have been put in place right now. So even though you have higher leverage, that doesn't mean things are more risky. You have more checks and balances. Like let's say, for example, earlier more risk used to be on banks. Now it's more like hedge funds and other market makers who are taking on that risk. Banks are not taking on that risk. So you're clearly containerizing the risk and shipping it off to like entities that can handle that much more better than risking like everybody getting affected by it. So those are like the main thing. It did increase but the risk measures that we put in place have been like much better, and we are at a better place overall.
And do you think it depends on the asset? So are, for example, some synthetic dollars like more fragile by definition, or it's just simply, a transparent version of what TradFi already does off chain that's just like mirrored on the blockchain?
Yeah, I mean, the term synthetic dollars is a bit strange to me because those, to me, that suggests sort of like a what maybe DAI was originally, where there was no like actual reserve asset backing at like a higher like order of money, basically closer to the Fed for USD stablecoins. There exists no at scale like synthetic dollar in that sense. I like there's the forgetting the name, the one that's like anyways, doesn't matter. Kind of like the DAI construct where it's like ETH as collateral and there's no like USDC or USDT that's a reserve asset to keep the peg. So Athena is the same as USDS in that regard. It's essentially fractional reserve banking. So these are the kind of splits that I would classify the stablecoins as. There's full reserve or USDC, PyUSD, and to a certain degree, Tether is full reserve. But that kind of changes depending on the interest rates, basically. But then there's like fractional reserve or like on-chain stablecoins, as I call them sometimes. And these are able to just issue loans like, banks and stuff like that. So these intentionally are, not holding just treasury bills in order to earn a higher yield and need to balance off these, the trade-offs in liquidity, yield, and safety. And so I think these types of stablecoins, just much like they basically just represent like dollar yield products. There's going to be a lot of diversity of them. The narrow banking case is actually quite commoditized. You have USDC for onshore, you have USDT for offshore, and it's very hard to differentiate beyond that on that side. But there could be a lot of variety of on-chain stablecoins, such as USDS and USDE. So USDS kind of anchors itself more to be like the capital on chain and transparent, and so focus around like CDP lending, where against like ETH and Bitcoin, these types of things. Whereas USD is more like basically just like a tokenized hedge fund, and so people like different things. They like different trade-offs, and so I think these products can coexist. And there's differences in liquidity. So like USDS has right now quite a large amount of visible on-chain liquidity. 50% of the balance sheet is actually in stablecoins right now, due to the market downturn mostly, and also growth of deposits. So I would consider that extremely liquid as far as like these on-chain stablecoins go. Whereas other stablecoins may be more deployed into various strategies. So there's just different risk profiles for everybody, and I don't think one size fits all. And I think a healthy competitive market is always a good thing.
Probably like the frequency points are different, Mike. Like if you think about, if you go back 2 years when Silicon Valley Bank blew up, USDC kind of like the peg, it fell down to like 94 cents. So each stablecoin has its like places or its weaknesses where it is like very fragile on, and we just need to understand that. USDE, it is probably more fragile to like, it is going on the assumption that perps and funding rates, they all kind of work and they don't necessarily break. So the one-to-one collateralization that they're doing actually, works all the time. What happens when, perps are basically put under stress, like on 1010? So there are like weaknesses for each strategy you pick. The idea is like which one are you comfortable with, or like I would say majority would be comfortable with basically like stable coins like USDC. Why? Because they would just say, okay, I prefer banks over like anybody else because they are more safer.
Yeah, I think that's an important point about USDC. So, like, yeah, there is some amount of the balance sheet that needs to be kept in bank deposits, unfortunately. But I think since that event, they've shifted more into like direct treasury exposure, less of like the fractional reserve banking system, which has and TradFi has its own set of problems. But yeah, I think for the most part, like I prefer having this system where not everybody is by default into fractional reserve systems, and the core stablecoins are like which can optimize for liquidity, can be very simple constructs, and we can build DeFi on top of these. I think this is a great way to go.
Yeah, and it's fascinating. I agree. It's the correct stable coin for the correct use case at the end of the day, right? And it's interesting because most people, I think, at least in my experience, most people that I speak with, they treat them somewhat interchangeably, especially if they're new to crypto. And we have another guest with us, which is DMH, which is the CEO of Fluid. And I think DMH, a very good question for you to follow up on this conversation is, from the liquidity layer perspective, could the synthetic dollar, as we call them so far, like outperform, the centralized stables in a crunch time? Or would, for example, the deep liquidity of USDC always win in those cases?
Hi everyone, and sorry for being late so much. Yeah, I think when Sam was speaking about synthetic dollars and that they're not synthetics as they used to be, I think they were called before algorithmic dollars, and that was nothing really about the dollars. It was just made up thing, like Terra USD, for example, and that was a very, very different thing. The synthetic dollars which we have now, like Athena one, I would say the name is sort of, I could say, correct one, because it's a tokenized strategy wrapped in a stable coin, into a stable coin form. Coming back to your question, like, can let's say synthetic dollars become an alternative for dollars that they're used to, like USDC or USDT? I think the main thing here is that users, they always want to exit, and like whenever they want to exit, they do it through mainly USDC. And synthetic dollars, they do not allow that at the moment. So they always depend on this liquidity with USDC. So users can treat it as long as there is USDC liquidity against USD, people treat USD as one USD. But if there were no liquidity for USD, then people cannot treat it that way, because people think they cannot exit, which is how DeFi works now. Like, people always think how they can exit, and there are two hard currencies for stablecoins. This is USDC and USDT.
Yeah. Oh, sorry, Sam, go ahead.
Yeah, it's just about the label, like synthetic dollar, because like USD is the same as USDS in that it pegs itself primarily around USDT. So there is like this, in order to scale up a stablecoin of any kind, you have to have redemption liquidity with an asset that has more liquidity. So you kind of have to pick this. So for USDS, historically the redemption liquidity is largely surrounding USDC, but Athena is like the same construct basically, and they're just primarily anchored around USDT. They also offer redemptions to USDC, and similarly, USDS also has a primary market now with USDT for redemptions, and PayPal USD actually now as well. So yeah, these constructs are fundamentally the same, basically, in my view. And I don't know, like a synthetic dollar, I think is maybe that's just my own personal thing, but to me, it just means more of like what you mentioned, where it's like this purely algorithmic thing, which is an interesting construct that we've come up with historically in DeFi, but it just, I mean, these things just don't really scale up.
And Sam, how does what happens if, for example, the liquidity dries up and like all the funding rates start spiking? How do these like USDE or USDS defend themselves against the peg?
Yeah, they just have to make sure they have lots of redemption liquidity. This is nothing new, right? This is just liquidity management. It's the same for banks, right? They have to be very concerned about bank runs, and so managing the portfolio, making sure you have enough liquid assets to be able to honor redemptions, especially in the case of a stressed event, is the nature of the game. And if you fail at this, then people will leave your product. So yeah, it's really like nothing new. And just DeFi has different terms for things that exist in TradFi for centuries.
Yeah, fair enough. Uday, I have a question for you as we're approaching the end of our time. But looking forward, right? How do you think that the regulators, now we're seeing obviously a lot of influence of like institutional regulations and like government in crypto and in the blockchain space. How do you think that regulators will see these type of, as we call synthetic dollars, like post this 2025 crash? Like, is it an innovation? Is it just like unregulated money that's not backed by really anything physical? Like, how does that work?
I think from a regulatory policy perspective, my thinking is they'll probably look at like how does it behave in a money like situation, like how is it used in payments, how is it used when there's a large size transaction is happening, what is being preferred, like what is the probability that a synthetic dollar could be used for like $1 million transaction compared to the others, maybe like other systemic interconnections. The main example is like how deeply are you connected uh, to your payment rails in general. And I think the parallel that they look for is probably around like a bank money or a security deposit. You would mainly look at like that would be the key, is like how are you behaving like USDC, or are you behaving like any like the normal stable coins that we knew, or are you behaving something else, and you want to be like integrated to all these institutions and integrations happening. That's when they would probably come in and say, you know what, time to stop. Otherwise they'll just let the innovation do its thing. Again, my views, I could be wrong, but yeah.
Do you think, maybe question for the group, that some sort of like rating or grading system will help with that, like it happens with traditional finance?
Yeah, I can start with that. Absolutely. I think this is a huge piece that is missing in DeFi right now. People are basically just using brands and APY to determine where to go, which I think has its use for sure. But the problem with this is that over time, as competitive pressures basically force brands to risk on over time, there needs to be also this check in place to make sure that the lenders, the user deposits are not being taken advantage of, basically. So I definitely think this exists in TradFi. There's tons of ratings agencies, S&P, Moody's, etc. And so I think this is a piece that is sorely missing in DeFi, and I think we need to get this in place before it's too late, because the default mode, everybody's going to just continue to pile into an ever increasing concentration of positions, and it will lead to systematic risk for the entire ecosystem if we don't have these sort of checks in place. And then when something goes wrong, it could mean the end of DeFi as we know it. And so I do not want this type of situation. I work and live in DeFi, and so I want this industry to thrive, and so we need to be proactive with these types of self-regulated. I don't know if self-regulation is or just self-regulation, I guess is okay term for it, so that we can make sure that everybody is safe. So yeah, this is a great initiative, and I think we're going to be looking more into this in the near future.
Yeah, I agree. And it's not only just the monetary damage at some point, it also becomes a question of reputational damage for the industry, right? So we've been always demonized as an industry, especially at the very beginning, right? And then the reputation of crypto, I feel, went up and up and up over time, over the past few years, and I think that the time is now mature for something a bit more structured in terms of security. The good news is that we're working on it. We, as RedStone, we just acquired Credora, which is the most successful, one of the most precise and awesome rating agency that there is in DeFi. So we're very much working to bring a bit more structure, a bit more reliability to the DeFi system as a whole. And I want to close for last question for you, DMH. What is the position of Fluid in all of this? What do you think is going to be the successful liquidity strategies moving forward?
Yeah, sure. But can I please comment on your last question about the rating system? I agree with Sam that it's very important to have rating system in DeFi, and it will allow for more unbiased view from the users when they decide like what protocol they want to use, and they can better understand the risks behind the protocols. But at the same time, there are a lot of problems with this ratings system, because it's very difficult to rate something, especially when it's coming to to smart contracts. How does the rating system define which smart contracts is safe or not? And there have been a lot of cases where extremely safe smart contracts were exploited eventually, like we've seen with Balancer just a few days ago. And then every protocol might have very fine tuning, and every protocol, every stablecoin might have some fine tuning that limits some of the risks, but it cannot be really picked up by the credit rating, by those rating agencies, as well as there is sometimes off-chain component for many of the things that cannot be properly verified, which will also likely put either bad rating or will not put this into consideration at all. So rating system is very good initiative, but how to make rating system usable, it's a very big question.
Well, I can speak to that.
Yeah.
I think over time, the smart contract risk for like major lending platforms is just going to trend to zero. So where it's going to be, like it's something we kind of got to deal with in the short term, but I think practices have just gotten a lot better, and over time, they're already just trending down. Like the stats on this are pretty clear. They still, there was unfortunate hack a few days ago with Balancer, but I think this trend is pretty clear. It's just going to rapidly go to zero. And so where's the risk after that? The risk is going to come from, again, it's going to transition to more TradFi assessments. Like, what is the collateral? What are the loan parameters? If it's an off-chain asset that's being tokenized on-chain, you have to do like structured credit analysis of what that represents off-chain. And so these sort of things are well known in TradFi. So we just basically have to adopt these practices. So I think it's totally achievable.
Yeah, but even if we're speaking about the collateral, same collateral, but every lending market has a different liquidation engine. If we are like thinking about very first liquidation engine of, let's say, MakerDAO, where you have this auction, this is one thing. Then we have a liquidation engine of Aave, which Spark is also using. It's another thing. Then we have a, let's say, liquidation engine which we're using on Fluid. This is completely different thing. And then, that's why like we have this very high LTVs in the industry, but we are not increasing the risk because we have high LTVs in the protocol. So again, you cannot compare initial, let's say, MakerDAO first liquidation engine architecture and, let's say, Fluid liquidation engine, compare them as the same, it doesn't work. So people have to look into the contracts, how exactly it works.
Okay. Yeah, I'm not saying everything is like this. This is more of like a marginal thing in my view. I think it's more important to like look at where these like big collapse events are. Like if we need to like solve this first, and I think ratings could do a pretty good job on that, like identifying what does the loan supply chain look like, where is the hard assets that are backing all of these loans, or maybe like they're loaned out unsecured or something like that. Like these are the types of like major key points that you need to determine first and foremost, and the details of like the liquidation. Yeah, like I think this is important to look at as well. But I think you can get like 80% of the way there by just looking at what is the collateral, what makes up the collateral, what is the liquidity of the collateral, the duration of the collateral, like this kind of stuff. And I think this is totally achievable at like getting most of the benefit. But yes, of course, there is a whole bunch of nuance if you want to go into like the marginal differences on all this stuff. But it's achievable.
If I'm looking at it as a risk manager who's evaluating like multiple stable coins, if I have like a risk assessment coming from like some reputed agency, which I can know for sure that it is going into like detail, it gives me some assurance. It doesn't give me complete assurance, but it will definitely give me like ways to start.
I think a lot of it depends on how something is done, right? And also, as we said at the beginning of the podcast, like nothing gives 100% assurance, like in the same way that like this is not financial advice. Nothing will give you 100% security that something is completely trustworthy, right? So we had collapses in traditional finance of like infrastructures that we thought they were unbreakable. So obviously, that is always to take with a grain of salt, but I do agree I think with all of you that it will bring us closer towards like more security. It will not be like a silver bullet, but I think that is something that is definitely interesting.
Yeah, and Uday, you shared in the chat actually. So this has been done already. USDS has a rating from S&P, so totally achievable in my view.
Yeah. So with that, gentlemen, this was a fantastic discussion. We just approached the end of our time. I love the conversation and the nuance that we had like between risk, philosophy, liquidity, all of these kind of things. And I think that at the end of the day, is not just, as we said, about like one solution, but it's about like balancing and how the implementation is for the different solution and how stable means stable, like in a more decentralized world. Sam, thanks so much for being here from Spark, Uday from Gauntlet, and DMH from Fluid. You're all great, and thank you so much for taking the time to talk to me today.
Yeah, thanks for having us.
Yeah, people follow these awesome people on Twitter and their great companies on Twitter, and we'll see each other soon for another RedStone Live. Have a good day.
All right. Cheers, guys.